A construction company can win a $1 billion contract and still make almost nothing. Turner Construction, one of America's largest builders, generated roughly $29 billion in revenue in a recent year. Sounds incredible, but construction companies don't get to keep most of that money. A contractor might make only a few percent after everything is paid. So imagine this. $1 billion comes in. Materials take a huge chunk. Labor takes another. Subcontractors, equipment, insurance, financing, taxes, delays. And suddenly that billion-dollar contract might leave you with only $30 or $40 million. And that's if nothing goes seriously wrong. Because in construction, one bad mistake can wipe out an entire year's profit. So how do construction companies actually make money? And how can a company look profitable one year and be completely bankrupt the next? Let's break down the business. Here's the first thing people get wrong about construction. They see a company winning a billion-dollar contract and think, they just made $1 billion. No, they just agreed to spend most of $1 billion. Construction is a gigantic revenue business with surprisingly thin margins. Globally, construction represents roughly $15 trillion in annual economic activity. But the companies actually building these projects can operate on margins that are only a fraction of their revenue. And that's why the industry is so strange. A contractor can be responsible for a $1 billion project, while only keeping a small percentage of it as profit. Think of it like this: $1 billion revenue minus materials, minus labor, minus subcontractors, minus equipment, minus insurance, minus financing, minus everything that goes wrong. What's left? Maybe a few tens of millions. And that tiny percentage is the part the company is actually fighting to protect. Which leads to an even stranger question. If the general contractor isn't making much, who is? The company with its name on the construction project isn't necessarily the highest margin business involved. A general contractor might manage the entire project, but underneath them are dozens, sometimes hundreds of specialized subcontractors, electricians, plumbers, HVAC companies, steel contractors, concrete specialists, roofing companies. And some of these specialized businesses can operate at better margins because they're selling expertise that's harder to replace. That's the hidden structure of construction. The bigger the project gets, the more businesses are taking a slice. The general contractor wins the giant contract, then they distribute pieces of that contract throughout the supply chain. And suddenly that $100 million project isn't one business making $100 million. It's dozens of companies fighting over what's left after the costs. But there's another problem. Before a construction company even gets one of those contracts, it needs money, a lot of it. You can start a tiny handyman operation with relatively little, but a legitimate commercial construction company, that's a different game. Trucks, trailers, equipment, licenses, insurance, workers' compensation, office staff, estimators, project managers, and then come surety bonds. A bond basically tells the client, if this contractor fails to complete the job or meet certain obligations, there's financial protection behind the contract. Depending on the project and the contractor, bonding can represent a meaningful upfront cost, but here's the real killer. It's not the trucks, it's not even the insurance, it's cash flow. Because construction companies often have to pay workers and suppliers before they receive payment from the client. Imagine finishing $1 million worth of work, but waiting months to actually receive that $1 million. Your workers still want their paycheck Friday, your suppliers still want their money, the bank still wants its payment, the building can be progressing perfectly, while your bank account is going in the opposite direction. And that's where construction companies start getting into serious trouble. Here's something that sounds backwards. Winning the contract can actually be the beginning of the problem. Everyone assumes the cheapest bid wins. Sometimes it does. But a low bid can hide a very expensive mistake. Maybe the contractor missed part of the scope. Maybe labor was underestimated. Maybe material prices were calculated incorrectly. Maybe they simply wanted the contract so badly that they accepted a margin that was too thin. That's the winner's curse. You won. Congratulations. Now you have to build the project for a price that might not actually cover what it costs. And on government projects, the financial stakes can be even higher. For example, the U.S. Miller Act requires payment and performance bonds on certain federal construction contracts. The reason is simple. If the contractor fails to pay the subcontractors, someone still has to be financially responsible. So the real game isn't who can win the biggest contract. It's who can accurately predict what that contract will actually cost. And that's where the math starts destroying companies. Let's say you're running a contractor with $50 million in annual revenue. At a healthy 6% margin, that's roughly $3 million profit. Sounds great. Until the project starts fighting back. You estimate a crew needs 400 hours. They actually need 500. You can't simply send the client another invoice because your estimate was wrong. You eat the difference. Now multiply that across dozens of workers and months of work. And labor has another hidden problem. A carpenter might earn $25 an hour, but the company's real cost isn't $25. Add payroll taxes, workers' compensation, benefits, insurance, and other employment costs. The true labor cost can be significantly higher. If your spreadsheet treats a $25 worker like a $25 worker, when that employee really costs you $36 or more, you didn't make a small accounting mistake. You built a loss into the project before the first wall went up. And labor isn't even the scariest part. Materials can move too. Steel, lumber, fuel, concrete. A fixed-price contract doesn't automatically increase just because your costs do. That's why contractors sometimes negotiate escalation clauses. If certain material prices rise beyond an agreed threshold, some of that additional cost can be passed through. Without protection, the contractor eats it. And then there's the nightmare scenario. Imagine your foundation is poured, and then someone discovers it's 18 inches off. The client doesn't care that your crew worked hard. The building can't simply move. So now you may need demolition, new materials, extra labor, engineering, more inspections, and potentially weeks of delay. Remember that $50 million company making $3 million? A major rework event can consume a huge portion of that profit. That's the brutal math of construction. Your revenue can look amazing. Your project can look almost finished. And one mistake can turn the entire job from profitable to barely breaking even, or worse. But there's an even bigger danger. A company doesn't necessarily have to lose money to die. It can die while technically being profitable. This is the part most people outside construction don't understand. Profit is not cash. You can finish the work, record the revenue, show a profit on paper, and still not have the money in your bank account. Construction payments can take 60 to 90 days, depending on the contract and payment process. And clients may also hold back retainage, often a percentage of payments until certain project milestones or completion. So imagine you've spent the money, you've paid your workers, you've paid your suppliers, you've completed the work. But the client still owes you millions. Payroll doesn't care. Friday still comes. And that creates the strangest sentence in construction. The building is standing. The company isn't. And one of the biggest construction collapses in modern British history showed exactly how dangerous this can become. Carillion was once one of Britain's biggest construction and infrastructure companies. It had tens of thousands of employees, government contracts, hospitals, highways, major infrastructure projects. From the outside, it looked enormous. Then the numbers started breaking. In 2017, Carillion announced an enormous £845 million write-down related to contracts. The market reacted violently. Further problems followed. The write-downs eventually exceeded £1 billion, and in January 2018, Carillion entered liquidation. Think about what that means. A company can have giant contracts, thousands of employees, billions in revenue, major government projects, and still collapse. The lesson wasn't that construction suddenly stopped working. The problem was what was underneath the revenue: thin margins, contract problems, cash pressure, debt, and financial assumptions that eventually couldn't survive reality. Carillion didn't disappear because nobody needed construction. It disappeared because the economics underneath the construction stopped working, and that brings us to two numbers. Construction companies obsess over, they're called overbilling and underbilling. Suppose you've billed the client for $10 million, but you've only completed $7 million of work. That's overbilling. From a cash flow perspective, you've received money ahead of the work. Now flip it. You've completed $10 million of work, but you've only billed $7 million. That's underbilling. Now you're financing somebody else's construction project with your own cash. And here's why this matters. A company can look profitable on its income statement, while its bank account is quietly running dry. That's why construction isn't simply about revenue, it's about when the money arrives. Go back to our $50 million contractor. Healthy year, $50 million revenue, 6% margin, $3 million profit. Now add a major material increase, one expensive rework problem, labor overruns, a safety-related cost, and clients paying in 90 days instead of 30. The buildings didn't change, the workers didn't change. The revenue might barely change, but that $3 million profit, it can disappear, and that's the secret of the entire industry. Construction companies don't really make money by pouring concrete. They make money by controlling the math around the concrete. They win the right contracts, estimate labor correctly, control materials, manage subcontractors, protect their margins, and most importantly, keep enough cash alive long enough to get paid. Because in construction, the company that survives isn't necessarily the one building the most, it's the one that understands where every dollar is going before it disappears. If you want more breakdowns of how giant industries actually make money, subscribe, and comment the next industry you want me to take apart.